because Ronald Reagan's advance was built on a tax-cutting boom that created more than 20 million jobs. Bill Clinton's a high-technology tear that created, well, almost as many jobs. Despite recent gains, net, this president has still lost jobs. Now, that could change, and the markets seem to be signaling things will change. But that means we're going to have to do this on spare change, because we don't have much change. In fact, with more than $16 trillion in debt, we have no change. And Washington, incapable of agreeing on a relatively measly $85 billion in cuts, well, we have no money either. Republicans are right to say we have to cut our way out of this mess, and Democrats are equally right to say we can't cut our way to prosperity. We have to boom our way out. No boom? Boom. So, how do you sustain a 5-year crawl? By making sure it doesn't turn into another crash. Easier said than done. What we have to do now is to make sure, well, it doesn't happen anytime soon. A bit later, I'm going to ask former NYSE Chairman Dick Grasso about that. But first, Swiss America Chairman Craig Smith, United Capital CEO Joe Duran. Joe manages over $15 billion in investment. Joe, did anything change today or punctuate and confirm what we've been seeing in recent days?
I think two things have happened that are important. One, the market is a reflection of our collective psychology. And until it hit a new high, I think the average investor was still in a what do I do to avoid losing money mindset. And when you go to new highs, which will no doubt be in all the news over this evening and this coming week, they'll start shifting to, am I missing opportunities? So that shift from fear of losing money to shift of missing opportunities is real. And what you see when you hit new highs is an inflow of new money. Unfortunately, for most of the people watching the show, the net flow into equities only started increasing in December. So for most people, we've had net outflows of stocks for most of this rally until 4 months ago. So to me, nothing fundamental has changed. You're absolutely right in your preamble that the fundamentals that were true in the past are not true today. And this is led by a lack of opportunities to invest anywhere else. Interest rates are hovering at 2%. There's no real place to put your money, and this is the best turned out to be fake and haven't had ramifications. What it means is people are saying it's not as risky to invest in stocks anymore, and it looks relatively more attractive to get your yield from stocks than from government treasuries, and that's what we're seeing today. Large cap, dividend driven, although it's unlike 2007, very, very broad, and that would suggest that there's more to come in this market.
All right, if there is more to come, history would suggest, Craig Smith, that there isn't a lot more to come. In most circumstances, when the Dow hits a record, it's a punctuating moment that's often followed, sometimes a little more than a few weeks, if not a few months, by something bad. We remember that in 2007. We remember what happened in 2008. We remember the early highs in 1987. And, of course, remember what happened in the fall of 87. The same with early 1929 and the fall of 1929. The market has a way of celebrating the good and soon thereafter looking at something pretty bad. What do you think happens now?
Yeah, we have short-term memory on some of the black swan events that have cost people billions upon billions of dollars. I think Joe's right. Most investors were taking a very defensive posture, and now they feel that they're going to have to run after the market for returns because they're sure not going to get it as sitting in treasuries.
But what's new? Are they doing that based on this Dow record today? If the money's been crawling in, are they taking money off the sidelines, so to speak? You can only get so much bang out of this buck, right?
You bet. And that's why I'm real grateful for the interview on Fox Business today that Liz Claman did with Bill Fleckenstein. You know, if you tune to the other networks, you saw it looked like cheerleading competition. Bill Fleckenstein took a very sober approach to this market. And look, you know me, Neil, I've always believed in diversification. You always have some money in the market, right, some money in stocks, gold, bonds, cash, real estate. But I got to tell you, for the corks to be popped off the champagne bottles now and to be talking about 15,000 or 16,000 Dow, unless Mr. Bernanke continues to pour I mean, Lance Armstrong won a number of Tour de France's. We found out it was done because he was pumped with drugs. Hey, guess what? That's what we've been doing. We've been pumping this market with trillions of dollars of drugs. You just made mention of the numbers. 17 trillion in government, 3 trillion in Fed. I mean, look, the stock market is very profitable right now. Corporation balance sheets look very good. If we do have a pickup in the economy, I think profits are going to be very strong, and then I'd be excited about the Dow. Right now, I'm still very cautious, Neil. All
right, Joe, real quickly, many are calling this the Ben Bernanke rally. This latest turn was really fueled by Ben Bernanke hinting that he's not done providing this drug or whatever you want to call it. So that's what's driving this. Is that true?
It is absolutely true, and it's not just here. It's happening in Japan. It's happening in Europe. What all the developed countries' central markets have done, central bankers have said, we're going to flood this system until we get inflation, till we reflate. And for me, the thing that concerns me most is top-line growth. You're not seeing the kind of top-line growth that you want to see. It's a lot of good profit-making, but not necessarily from growing. And you see that from the fact that companies are returning dividends and buying their stock, which in essence supports high earnings growth, but not necessarily revenue growth. And for the stock market to have a really long-term run, you need to see GDP growth, revenue growth. Now, that's not true in emerging countries, and a lot of companies making tons of money in the emerging world where there is real revenue growth and GDP growth.
All right, gentlemen, I want to thank you both. In the meantime, we do want to bring you up to date on another development.